All right. What's going on, everybody? Welcome to the September version of our live Q&A session. There might be some other people who join, or there might not be, and there might just be some people who listen to all this later. So feel free to just jump in there and post any of the questions that you end up having. Maria, thank you for confirming that you can hear. I'm glad to have you here. And like I said, I mean, if this ends up being like kind of a smaller group, I'm totally okay with that. What we're always trying to do with Prosperity Society is just build a community of people who have a place where they can go at least once a month to get answers to their questions, or just listen to what anybody else is asking. So that's definitely a process as we kind of build out this platform and community. But I am excited to just let everyone know that there is over 100 people that are part of Prosperity Society now, and that number is just going to continue to grow. So I'm committed to do these whether there's 2 people in here or 200 people in here. So hopefully we just kind of get a good conversation going, and hopefully there's just some valuable content that ends up coming out of all this, so that you get the meaningful content that you're looking for. Right now, a lot of people are probably tied up with the extension deadline. September 15th was the business deadline. October 16th is going to be the personal extended deadline. So I'm kind of breaking away right now from the grind of just doing all those personal tax returns and taking a little break and doing a little Q&A session right now. But accountants might be kind of tied up with that. So if you're not hearing from us, be patient with us and send those gentle reminders on some of the stuff that you need to know. Either way, though, I'm excited to just get into it a little bit today, and definitely want to answer some questions that I've been getting recently. The first thing that I'm going to talk about is bookkeeping solutions. Everybody knows what QuickBooks is, and some people use desktop. The majority of people are on QuickBooks Online. There is like a 50, depending on the level of service that you have, there's a $50 or $60 monthly fee that kind of goes along with this. Somebody asked me the other day, hey, if I'm not really in a spot where I can like hire a bookkeeper, like what is your suggestion as to what I should do? And so, my response to that question, because it is one that I get quite a bit, is that as long as you're doing everything through business bank accounts or business credit cards, you're always going to be able to like download that activity for the year into a spreadsheet. And so last year I ended up having like this little side business that I was doing, and I did it all through one account. And I'm kind of getting towards like the end of the year and like just needing to do my bookkeeping. I knew that everything was kind of in one place, but I hadn't really like went through and like coded everything. And so one of the things that I kind of, let people know is that if you have some basic Excel skills, you could really whip together some bookkeeping if you want to try to save the monthly cost. And so what I ended up doing was I exported everything from those bank and credit card statements, and I exported it to Excel. Then what I ended up doing was just creating a bunch of columns where it was like the date, like what the transaction was, what the amount of the transaction was. And then I created an extra column like that was called expense type. And what I did with that expense type is I then sorted my whole spreadsheet by the type. And what that did was it grouped together all of the stuff that is all kind of similar, right? So for me, if I have like 20 McDonald's charges for, like employee breakfasts or something like that, all of those were then grouped together. And then in the expense type column, I went through and just put in meals. And you can drag it all the way down and kind of group together all of the expenses at one time. And then you go into the next section and you just go through, and it took me a couple hours, but I ended up going through all the transactions and I grouped them together by what they were. Once I ended up doing that, then I sorted it again by type. And when I sorted it by type, now all the meals were together, all the dues and subscriptions, all the payments that I made to bookkeepers or whatever it is, all of that stuff became sorted and kind of grouped together. And then what I could do is just total the groups. And then I kind of knew what all my income and expenses were. So you need to have a little bit of Excel skills to be able to do that. But it's an alternative to, going and hiring a bookkeeper and having a $50 a month QBO charge, or having to go learn QuickBooks online yourself because you don't want to pay the bookkeeper. And it's just one of those things that I wanted to just offer as like some kind of personal alternative to when maybe your business is just small and you're still trying to kind of get it off the ground. So there's that. Maria, you're asking, does a credit card have to be the name of the business, or can it be under your personal name and paid by the business bank account? All right, so I would always suggest when you have a business, especially an LLC, to do as the least amount possible with anything that's in your personal name. Now, if you use your personal credit card and it has business expenses on it, I'm okay with like kind of moving those expenses over to the business, or having the business reimburse you personally. That's even better. Having the business reimburse you personally for whatever you paid for. But I would keep them separate. I wouldn't make a practice out of having a personal credit card and then using business funds to pay it off. There is some little like corporate veil type legal jargon that is out there, to where if you're intermingling stuff between business and personal, then you kind of can lose some of your LLC protections. The reason that we set up separate LLCs is because we want to box off our legal liability risk into just the LLC. If transactions are flowing between the two, it's kind of like this really isn't a separate entity. So my suggestion would always be to first set up a business bank account, second, get a business credit card, and just run everything through there. If you're in a spot where you're like, yeah, Ronnie, I kind of ended up doing stuff personally, maybe what I would do from there is say, okay, tally up what those expenses were and then have your business reimburse you for those. And then when the business reimburses you for that, make sure you kind of line item what they're all for. The one thing that happens sometimes is somebody will have a situation like that and they'll say, hey, I paid my $3,000 credit card bill. They were all business expenses. Well, then I'm sitting here and I'm like, well, what kind of business expenses were they? Because when I do the tax return, I break it out between meals and postage and gas, and I break out all the different types of expenses for whatever that $3,000 was. And a lot of times they're like, oh, it was just office supplies or something like that. And we're kind of like, I don't really like to play that game. Like, I want you to break it out and not intermingle stuff. So hopefully that kind of helps answer that question a little bit. Not the worst case. You don't lose, like a lot of people will think if they didn't do it through their business that they just lose the deduction. That's not really true either. We want to make sure that we pull in the personal expenses and make sure that you're either reimbursed or we at least journal them into your books. All right. Hopefully that's helpful. Good. All right. You said thanks. So good. Keep them coming. We love those types of questions. That's really, really good. All right. Ray says Quicken and QuickBooks is not too hard to use and able to sort expenses and income rather quickly. Ray's an engineer though. Ray, you're an engineer. You know how to like figure out that kind of stuff. Some people, they get into QuickBooks and they're like, oh, like what do I do? But I appreciate the comment and definitely keep them coming. Megan, I saw you jumped in and I know you have a question. Pop your question into the chat feature just so everybody could see it, and then we'll go from. I'm gonna get to it. I do want to open up really quick though. Ray sent me a question via email, and I want to get that to him. All right, so in certain situations where maybe you have a large estate and you have money and you have kids and you have grandkids, you've all heard about the limits for gifting and how you're allowed to give $17,000 to maybe a grandchild and without having any tax ramifications. That's baseline. You, like husband and wife, can each give a grandkid $17,000 a piece. So, and if it's more than that, you have to file a gift tax return. So a lot of people like just cut it off at $17K so that they don't have to file a gift tax return. So Ray's question is this: he ended up putting money into an account for his daughter when she was a kid, and now what he's wondering is he has a grandkid, and they want to see if they could transfer the money that's in that account to the grandkid, and it's all in stocks right now. So the question is like, do we have to sell those stocks in order to transfer it, to the kid's account? I'm fairly certain that financial advisor would be able to facilitate that transaction without selling the stock and realizing capital gains. I'm fairly certain that you would be able to do that. Now, if that amount is over $17,000, which I believe you told me it was, you can split the amount that's in that account between you and your wife as gifts to the grandkids so that you don't exceed the $17,000 limit. So in theory, you really can go up to $34K with a specific grandchild. You shouldn't have an issue with that, but that's going to be something that like your third-party administrator or your financial advisor is going to end up facilitating. Another question is, which one's better? A UTMA account or a UGMA. And so, these are gift to a minor account is what these are. And there are kind of like pros and cons to both. Some of those pros and cons were kind of spelled out, so I'm not going to necessarily go through those. But it said, the question was, can you also use these funds to fund a Roth IRA or a self-directed Roth IRA? When you have funds that are in those minor accounts, there is an ability to fund and use that cash. You could pull that cash out and use it for something specific. The only problem with like a Roth IRA is that the grandchild is going to need to have earned income in order to be able to fund that Roth IRA. So you can't just say, hey, I want to put $6,000 into a Roth IRA. That's just not something that automatically happens for everybody. That grandchild has to have earned income, so they need to have either W-2 income or 1099 income that justifies being up to the amount of the contribution to the Roth IRA to justify that. So, whatever, the grandkid A, they would have to have a W-2 for $6,000 in order to be able to contribute $6,000 into a Roth IRA. But yeah, it is possible for kids to do that, and it's a really good tax planning tool. There's some other stuff in here, but I think I hit the bold questions that were in there. If there's more to that, Ray, post it in the thread for me, and I'll get to that, or we can just kind of chat on the side about it. But I do feel like that's good information for the group. Maria ends up asking, do you have to report it if you receive the gift? The answer to that is no. If somebody gives you $20,000, you don't have to report as a gift. You don't have to report that in any way to the IRS. The person who's giving the gift is the one that is responsible for filing a gift tax return if they're required to do that. So yeah, people love those gifts there. All right, Megan ends up saying, I'm curious what tax benefits there are with having farmland. What is required by me to get the fullest on those deductions? So, farming is a very popular endeavor in the United States. There's a Schedule F that on tax returns that is specific just to farming. And so if you have a farming venture that has a business purpose, then you're going to be able to treat it just like any other business. Buying land itself is not going to be something that is deductible. So if you go, land is not depreciable as an asset. So you're not going to end up getting any tax deductions just from buying farmland. Where the tax deductions would come on this is going to be when you use that farmland to create something that is income generating. So let's just say, for example, like I've got somebody right now who are growing a herd of cattle. And what they ended up doing is they bought land a couple years ago, and for the past like 2 years, they've been buying cattle, working on that land, putting fencing up, buying tractors and equipment, and setting up feed stations and all of that kind of stuff. And what they're doing is obviously tracking all of their expenses on it. You're able to take expenses on all of that kind of stuff as you're growing the operation, but your once you start buying and selling cattle, now that's kind of like your income and expense that justifies having all of that stuff. You're not going to be able to just buy land, buy a tractor, and then, expense $50,000 for the tractor and then never do anything with it. Okay, you're going to have profit motive. You're going to have intent as far as some legitimate operation goes. If you ended up setting up an LLC, I think that's a good idea. If you had a business bank account to go along with it, that's a great idea, because now you're showing like, hey, this is the intention for this is to be a business. You want to be a business, and you want to show intent, and really you're going to have to show profits at some point. I mean, you might be able to take losses for the first 2 years, but eventually you're going to get the crop, or you're going to have the cattle all beefed up and sent off to the slaughterhouse or whatever. You're gonna end up doing all of that kind of stuff, and kind of go from there. But yeah, there's definitely good deduction opportunity that goes along with farming, land, crops, all of that whatever you're gonna end up doing. There's gonna be opportunity for you to take deductions on that. And, as long as you're active in it and everything like that, it would be something that would offset your W-2 income or your business income. It's like ordinary deductions. So that's really good. All right, great question. If it's more of a hobby and it won't make much more money, compared to the purchase of the tractors and stuff, should it be multi-member or be taxed as an S corp? Okay, doesn't matter if it's multi-member with you and your husband. I would say you'd want it to be an S corp if you're going to have legitimate operations and you're going to make a lot of money from it. Other than that, doesn't matter. If it's going to be a hobby is like that's a buzzword in the accounting community, and something that the IRS loves. They would love for all of our side hustles to be considered hobbies, because when something is a hobby, you're never allowed to take a loss from it. Okay? And so if you have something that you would classify as a hobby, your income and deductions get capped out at zero. So like if you made 10 grand and you had $20,000 of expenses, if it's considered a hobby, you have to stop at zero. You wouldn't be able to take the $10,000 loss. So nobody wants to call their business endeavor a hobby. But if it truly is a hobby, then call it for what it is and break even on it. But up front, you wouldn't be able to, like take all the deductions for tractors and all that kind of stuff. So most likely though, if you have some kind of income generation potential on it, I wouldn't necessarily call it a hobby from the beginning, unless this really is just fun, setting up a little farm, doing a little work for the kids. If it really is that kind of thing, then maybe I wouldn't like push the gas pedal down really hard on taking a lot of deductions. Because you wouldn't want the IRS to come back later and disallow those deductions, and then all of a sudden you have to pay back a bunch of taxes and interest and penalties. All right. Hopefully that's helpful, Megan. And if you have more questions on it, I'm like super happy to be able to answer those questions for you. All right, let's see. What else do we got? Pop anything else in there that you guys have. I'll give a little plug right now for what's going to happen over the next month. In about 2 weeks, I'll be done with the 15th deadline. And once I get done with the 15th deadline, I become a lot happier and a lot more available for tax planning. And for anybody who is maybe newer to like working with me or just the end of the year process, I usually spend like October 21st through like December 21st, that kind of couple month period, just doing a lot of tax planning phone calls. And so, we will hit on all the good things like buying equipment and retirement planning and spending money, reinvesting in your business, charitable donations, health savings accounts. The Prosperity Society will be loaded up with all the different tax planning ideas that are available out there. And so we really hit that stuff really, really hard towards the end of the year. That is where the magic happens, guys. I try to kind of tell everybody that, but every year I get people that are coming in March, April, and they want me to do some kind of magic on their tax returns. And after the year ends, there's just not a lot we can do about the previous year. So, you'll see messages going out from me that will be talking all about some of these different ideas, pushing you guys to set up calls with me and all that kind of stuff. So that's my tax planning plug, most important time of the year. And we definitely work hard to make sure that we really build our value at that point in the year, more so than just like knocking out your guys' tax returns for you. So huge tax planning opportunities upcoming. All right, let's see. Should a multi-member LLC that is not a married couple and not a hobby be taxed as a partnership or an S corp? So what I'll say on that is usually when it is multi-member, not husband and wife, it could really go either way. I tend to do partnership if the two people are maybe involved in other things and this is a side hustle. Partnerships will create more self-employment tax for the owners, but they're so much more flexible. So like if one partner is doing more of the work, it's really flexible for that. If one of the partners needs to take distributions and the other one doesn't, it's super flexible for that. So we love partnerships when we need to have like flexibility. We love S corps when both partners are going to be doing the same amount of work. We love S corps when we have a big opportunity to save on self-employment taxes. However, we know S corps are more rigid. We know that they have to have pro rata distributions based on ownership percentage. And so, some of those types of things are going to be reasons and things that we're going to talk through when trying to figure out what the best entity selection is for you. If it's real estate, it's always probably going to be partnerships. S corps are not good for real estate 99% of the time. All right, let's see. I need to chat about all the things. That's probably tax planning. I've got a couple houses I'm thinking of selling, but not sure if I should do it this year or next. One of the things that we'll do during tax planning with everybody is we go through and we will kind of like, hey, what is your income for the year? Tell me the different amounts that you have. Let's look at what tax bracket you're in. And so when it comes down to making decisions about, hey, should I sell the houses this year or next year? We could give you a lot of clarity on that. So I think that would be something that will certainly be beneficial for some of our calls, but we'll definitely take care of that as part of the tax planning process. Multi-member LLC, what if it's for a rental property? Partnership, every time, okay? Every time you're going to be a partnership on that. If one member is passive and the other is a real estate professional, that is totally fine. You're still going to be partnership. The passive activity rules or the real estate professional rules are going to be determined at the individual level. So no stress there. We'd be able to determine, even if one partner is one thing and the other is the other, there's no worries with that. We're still going to do partnership in a real estate LLC 99 out of 100 times. The only time that I would ever do an S corp with real estate would be in a circumstance where somebody wants to sell let's say they had a personal residence, and a lot of you guys probably know that when you have a personal residence, you get a capital gain exclusion if you've lived in it for 2 out of the last 5 years. There's scenarios where maybe somebody would have lived in it for 2 years and then turned it into a rental. And when you go for the next 3 years, you get to that point where, like, if it goes over 3 years, you're going to lose that capital gain exclusion. There's times where we would create an S corp, sell the real estate to the S corp at a fair price, preserve the capital gain exclusion, like recognize the capital gain exclusion so that you don't lose it, and then hold it in the S corp. That's the only time that I could think of that's going to be really smart to have real estate in an S corp. But good questions. I love that. All right, let's see. What else is on my mind right now? For my high net worth, high income earners, we've been having, and when I say high, I'm talking you make $500,000 or more. We've been talking about these land conservation easements. And land conservation easement is probably a lesser known tax reduction strategy. And I'll call it a tax reduction strategy, but I'll also call it an opportunity to like save the planet and make sure that the most beautiful places never have like housing developments or business developments on them. It's called a conservation easement or a preservation easement because there's a guarantee that it will never be developed. Okay, and so that two-pronged thing right there is going to be an opportunity. And so just for the knowledge of the group here, the conservation easement is a situation where you jump into a specific piece of land that's going to have an easement put on it, a promise to never develop, in exchange for the money that you put into it, you receive a charitable donation. Usually that charitable donation, depending on appraisals and different things like that, comes in at like 4 times whatever you put into it. Maybe even up to 4.6 times whatever you put into it. That's been something over the past couple years we've done a decent amount of, and have looked at it for people who are interested in kind of the conservation process. So if you get if you put $100,000 into it and you get a $400,000 donation, that's really good, because if you pay a 40% tax rate, you're going to end up saving 400,000 times 40%, which is 160,000 in taxes. You only put 100,000 in, so you get like a nice 60K spread there of tax savings. Now, the government has this in their tax code, but it doesn't mean they necessarily like it as part of the tax code. So there's a ton of due diligence that kind of goes into all of that. And you want to make sure that all of that due diligence is done appropriately and correctly, and there's groups that focus on a lot of that kind of stuff. So right now we've been having a lot of calls that are centered around that, and you look at how much money people are making. You're looking at the limitations. So you're limited to 50% of whatever your age-adjusted gross income is for charitable, non-cash charitable donations. So if somebody makes $1 million, you have $1 million times 50%. You can only have a charitable donation for $500K. So you could put in $125K and get that $500,000 deduction, and you're fine. But you don't want to put in more than that, because then you're gonna have losses that charitable donations that you're not allowed to take. So we've been doing a lot of due diligence calls on that, just kind of making sure that that people are looking at a really good strategy. So that's something that's been on my mind, something that I've started doing already. So if you're end up listening to this and you're like, hey, I'm high income and I haven't really heard about this yet, do a little research on conservation easements and let me know ASAP, because we're going to wrap this part of tax planning up within the next couple of weeks. But good opportunities, and something that we've worked on quite a bit. Ray says, how does the capital gain exclusion lower when you live there 2 years after having it as a rental for 3 years, rather than living in it for 2 and then having it as a rental for the next 3? It doesn't matter. As long as it's 2 out of the last 5 years, you're going to get the same capital gain exclusion. It's $250K for a single person and $500K for a married person. So it doesn't change that way at all. But you have to live in it. It has to be your personal residence for two out of the 5 years. Let's see. What else do we got? All right. Let's see. I think with maybe I'll just kind of close it out. If there's no other questions, I just want to close it out with realizing that the next few months is big for tax planning, and I also want to close it out by saying that Prosperity Society is going to be something that I'm kind of going all in on and really kind of pushing. So if you have specific content that you want me to do for the platform, I want to know about that. I want you to tell me what it is, because I want to make this a really big value add for people. So I know we've done a lot of the Q&A stuff for free. We've let people kind of come into that. It's not always going to be like that. We're kind of tightening up some of that, but we wanted to make sure people could kind of see where that value was, and we want to make sure that people understand hey, it's really good to have a CPA who knows what they're doing, knows what they're talking about, in their back pockets when they have business. And we've set that thing up to where it's a no-brainer to join. If you go on the site, it's $499 is the listed price. We give a coupon code for people who are our clients that we know and we like. And so it's our capital RNW client, capital R and then lowercase NW client is what generates the half off discount code. So I want to encourage people to jump into that because we're going to be committing a lot more to it, and I think from a value perspective, we've hit a home run on it. So, anyhow, just want to push you guys into that, push you into yeah. Let me type that out for you. Push you into joining the platform, Maria. If you're not part of it yet. There's probably like 75 videos on there now that are all centered around tax reduction, tax compliance, what you can deduct. It's $249 for a year's membership on it. And in the end, like, you are going to save that $249 over and over again. So I'd love for you to jump into that and join it with us. And you can do that. All you do on the website is just click on join the community, and you kind of just move through those steps in signing up. But we want to add value for you, and I look forward to doing more of it. We're a little late on the Q&A session this month. We want to get one in every month, and we're kind of cutting it right at the end of the month, but it's because of deadlines and stuff like that. Once I get through these deadlines, I don't know, maybe I won't look so tired or something. But hopefully everybody's doing well. I appreciate you guys all being here. Ray, thanks for being the stalwart, consistent person that I always know that I could count on these calls. And we will continue to just build this out for you guys. Thanks so much for joining the September Q&A session. Have a great day.